It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. On CCOM Satellite Systems, symbol CMI and the TSX Venture, trades around 215, 214, market cap of around 87 million. This is a company that we recommended years ago when it traded back in the 40-cent range and subsequently sold. It's a good, solid business. The company's a leader in the development and deployment of commercial-grade mobile auto deployment satellite-based technology for the delivery of two-way high-speed internet, VoIP, and video services into vehicles. Now, let's look at the recent financials. The company has been hit during the pandemic. CCOM's revenue dropped 42.9% to 1.01 million from 1.77 million in the third fiscal quarter. Revenues for the 9 months of this year were up around 61% to 6.57 million from 4.08. The company posted a net loss in its last quarter, about 157,000. Year-to-date, net income was 1.1 million. That compared to a loss in the same period of last year of around 400,000. Now, the company on January 11th did announce a $3 million US orders for its iNetVu antenna systems. So that is definitely a positive. The company sees rebounding sales and business from around the world in its 2022 fiscal year, the current year. So that is a good thing. The balance sheet here is solid. They have cash and cash equivalents of about 16.5 million with no real debt. So if we look at the valuations, we're going to take out that cash around 39 cents per share that is cash on hand. The company still trades at around 50 times trailing earnings. Now, again, we recognize that COVID-related slowdown has depressed revenues near term. It's likely that revenues and earnings pick up over the next 12 to 24 months. But at present, CCOM trades at high valuations. Again, it's a solid business, pays a solid dividend. At this time, it's paying that from the cash on hand. As we said, it was negative in terms of profitability in the last quarter. They do continue to innovate and invest in the next generation of their products. That's what you can do when business is down and you have a good, strong balance sheet. And there's a number of strong patents in the business. In a normalized period, the company has better cash flow. But we do see quarterly numbers being volatile overall. The results this year should be better than last year. But again, the company still trades at a premium. We will monitor the business, see if there is an entry point, but it's pricey on a trailing basis given the lumpy nature historically of its quarterly results. We do see the company as a potential takeover target at some point, but do not recommend purchasing just based on takeover target potential, because that could occur 1 year from now or 10 years from now. So we'll monitor the company at this point. We don't think it's an entry point right now.